because exits obviously is the language, is literally, the North Star for stakeholders. So what are the likely paths both for investors and for startup founders?
If you're at the early stage and you're looking for the highest exit possible, and you're trying to sell to someone who's trying to get in at the lowest price possible, you're naturally going to have tension. So in mature markets where things happen very, very rapidly, so in Silicon Valley and some of the more mature ecosystems, that there's enough momentum, there's enough speed, there's enough liquidity that the later stage investors can afford to, in some cases, pay a little bit of a premium for the early stage, so that capital recycling can happen. But in the African ecosystem, it really doesn't. So this is one of the biggest challenges that we're facing now, is that the entire ecosystem is too nascent, and in the absence of that capital recycling. Maybe one other really important point to make is just that at the earliest stages, a lot of those investors are investing off their own balance sheet. So angel investors, seed investors, typically are investing off their own balance sheet, which means that they've kind of got spare capital lying around. But once they've invested that capital, they need that capital to come back in order to make another investment. So in Silicon Valley, where you see maybe a 4-year cycle, you might lose your money, but within 4 years, you probably earned back. You've gotten out of the investments you put in. If you get a 3 or a 5x return, then that's 3 or 5 times more startups that you can go and invest into. In the African context, that cycle can be 7, 10 years or longer. So really, the available capital you have to invest into more startups is whatever spare change you've earned from your normal activities.